2025 has ended. I made a gain of 21.18%, more than the S&P 500. And in this video, I will show you everything that I learned from 2025. Because a lot of things happened. You had a new president in the US. You had this new wave of innovation with AI. A lot of things happening in the market in many countries at the same time. And I'm sure 2026 will see even more volatility, because now markets have become expensive. So yeah, I want to do a recap video and also show proof of performance. So in case this is your first video from this channel, welcome. My name is Christophe Nour. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 24-25% per year. Actually, I can show proof of what I say because I'm a public investor on eToro, which means my performance is completely public. You can click a link in the description below and have access to my portfolio live. Every day you go on eToro and some people copy my portfolio. I have 360 copiers. If you don't want to do the work, you can copy my portfolio. And all my friends are doing this, by the way. And you can see the stat in 2025, 21.18%. If you can compare this, I have this table with my performance since I started investing, and in comparison to the S&P 500 and the Dow Jones. What you can see here in 2025 is that I made 21%, the S&P 500 made 18%. So that's a 3% alpha. And the Dow Jones had a performance of 13%. So the CAGR, the new CAGR, compound annual growth rate, for me, it's 24.4% compared to 14.3% to the S&P 500. So far, I am outperforming the market by 10 points for 1, 2, 3, 4, 5, 6, 7, 8 years. And by a lot more for the Dow Jones, actually. So pretty happy with the performance. And in this video, I will show you what I learned from this year, because it's been a very, very volatile year. And the first point, I have some notes here. The first point I want to make is that in the US, you have a new president, right? You have Trump that is now here. And after a couple of months of being the president, he announced the Liberation Day with a lot of tariffs for all the countries, and people freaked out. Maybe you are watching this video right now and you panicked in March, April. It's okay. It's normal. A lot of people that were not invested for the first mandate of Trump did panic, and that's okay. A lot of people have forgotten that we had a first mandate for Trump. So we know exactly the playbook. We know exactly the kind of threats we will have and the negotiating tactics he uses. And what I learned is that, as always, people don't learn from history. And I remember vividly we talked about tariffs inside my coaching program. Inside my group, I have a coaching program. I help people increase their performance. And in April, some people panicked. And we talked about the playbook from the first mandate between 2016 and 2020. Actually, history doesn't repeat, but it rhymes. And if you don't know this, you can panic sell at the worst possible time. So the majority of the people inside the coaching program benefited from the situation, because as everybody was freaking out, we bought more, actually. A lot of people bought more and bought quality names available at a discount, including Google, including Lam Research. So you can have some pretty good deals if you buy when people panic. And I'm strongly forecasting you will have more dramas, more panic crashes, drawdowns in the market for the next 4 years. Why? Because it is exactly the kind of situation we had for the first Trump mandate between 2016 and 2020. In 2018, we had two crashes, I would say, for two panics. One in April with some potential tariffs for steel and aluminum, and one in December when the Nasdaq dropped 30%. Guess what? You wait 1 month, everything rebounded. And 2019 was a beautiful year with beautiful gains. So it's always the case. you have a lot of volatility, a lot of threats, big down, big up, buckle up. A key lesson I have for you is to buckle up, because you will have more situations like this. People will freak out. All the YouTube videos will have red thumbnails. This is a business after all. You will have more clicks because the thumbnail is in red. People want to see blood, even their blood. So it's life. And I'm strongly forecasting the situation will continue. You will have more things. Let me remind you that in 2018, a big panic moment was some nuclear threats from North Korea and Trump threatening North Korea to annihilate them, like literally enter war territory. And then they took beautiful photos, look how slim they are, etc., etc., to shake hands and to take some good pictures. This is life. Deal with it. So don't freak out about politics. Just stay invested in quality companies. Don't think too much about macro, because macro stuff will change a lot. You will have a lot of threats, a lot of new tariffs, and then back off completely, and then tariff back again, and then back off, and then remove. And my key advice is to not spend too much time over analyzing everything, because you will become crazy. Okay, this is not very helpful. The goal, my strategy after all, is to invest in good companies that are doing well regardless of the environment. If you have inflation, so be it. They are profitable. If you have interest rates, so be it. They don't have a huge debt problem. If you have tariffs, so be it. They are very strong with nice margins. They can offset this wonderfully. So if you fill your portfolio with companies that do well, regardless of who's the president, regardless of who's attacking who, regardless of the inflation interest rates, you increase your chance of outperforming the market. And this is a great lesson for all my clients inside the coaching program for 2025. You don't want to be invested in speculative companies that are getting impacted by what Trump says. You don't want to touch these special situations, because maybe the stock will run up immensely and then the president will say something, the stock will crash immensely, and you will cry and panic sell at the wrong time. No, this is not the way I like to invest. This is not the way I teach clients how to invest, because I don't believe this is how you will outperform the market. Inside the coaching program, I don't promise spectacular gains. I don't promise like you will make 30, 40, 50% per year. But I can tell you, you can outperform by a few percentages every year. Sometimes by a small amount, sometimes by a huge margin. But over years, you want to survive, and you want to survive through the cyclicality and to outperform the market by a little bit every year. This is the most consistent way I have found of outperforming the market. And so far it is working. I mean, you wait 2 years and we have 10 years of investing. I'm almost at 10 years of investing, a full decade. I'm young enough, so I have time with me. This is really helpful actually. Second thing that I have learned for 2025 is the AI sentiment is weak, and the AI sentiment moves a lot. Who remembers DeepSeek in January? People realized that China was in the AI race. They could have the results with minimal resources. And we learned after some months that Chinese guys stole NVIDIA products through Singapore. We learned that DeepSeek people cheated on their results. Oh, funny, right? It's like as if it was the first time it happened. But in January, that was the big name, DeepSeek moment. What if we don't need this AI build out, data center build out, big capex projects in the future? What if we can be more efficient? And everybody freaked out. You wait 2 months, 3 months, people forget. You get bullish again. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. The perfect example of sentiment swing actually is Google. Google had a beautiful run. But before it was down a lot. Let me show you Google. Let me translate in English so you see better. I mean, Google is just incredible. In 2025, between January In April, May, the stock was down 20%. And then from the lows, or roughly the lows, it doubled. Nothing really changed. They just implemented their strategy and they worked a lot, and they had Gemini as the best LLM. So nothing really surprising actually. Maybe if you go from second player to first player, maybe you would think the stock price would go up by 20%. No, it's a double. And now people are extremely, extremely bullish when it comes to Google. I made a video a couple of days ago about trimming Google because I just trimmed Google. It's no longer a 15% position in my portfolio. It's an 11% position in my portfolio. And some people are getting delusional with Google. Like, regardless of valuation, they're buying it every day. I would say be extremely cautious of being delusional in this market because the sentiment can swing. Now people are getting bullish a lot about memory. And I understand why. I mean, I've been following the memory market for a while now. If you look at Micron on a run, SK Hynix on a run, you look at Samsung on a run. Memory, you have a bottleneck. Micron delivered a spectacular earnings report about memory fully booked out for 2026. So yeah, a lot of euphoria. Be extremely careful if you want to go into these markets. I am not invested in Micron because I don't think I'm a genius and I don't want to touch this. It's too speculative for me. But I am invested in a company that is in a similar industry. If Micron benefits, Lam Research benefits. And Lam Research is what? 5% of my portfolio? 6% of my portfolio right now. On a run, on a wonderful run. And I have been trimming the position. And now I'm just letting it run. If it goes up, so be it. But I made a double with this stock and cut the exposure by half. So I'm just playing with the house money. How do you say it? Money of the house. I don't know. Just enjoying the gains. I took my principles. And now if the gains go up again, so be it. But the valuation is stretched. I mean, Lam Research right now, they have a PE ratio of 45. All the companies in the chip industry, PE ratio of 45, 50, things are kind of getting crazy. For Micron, people look at the PE ratio as if it was useful. The PE ratio for Micron has never been really useful, actually. This is not the good way to value Micron. People look at a low PE ratio. I would not say this is a good indicator for Micron because of all the cyclicality aspect of the business. You have other ways of analyzing Micron that I favor. But yeah, we have all learned how weak the AI sentiment was. And maybe in 1 month, 2 months, you will have more shocks. Another shock coming from Japan, coming from Europe. No, let's not kid ourselves. It will not come from Europe. From China, a DeepSeek 2.0, a DeepSeek 3.0, they will come. Or something else from Europe. Or maybe some companies explode. Maybe the Magnificent 7 are cutting the capex. Maybe Nvidia finds a new way to be more efficient so you don't need as much capex as needed. It's possible. Maybe Oracle will lose. You have big risks in this market and you need one shock and all the AI trade will go down 20%. All the speculative plays around AI can go down 20-30% and then rebound and then go down. The AI sentiment is extremely weak. So in case you have some AI names in your portfolio, I would suggest to be extremely careful because now valuations are stretched and we have a lot of euphoria. Next point, in a world with inflation, asset owners keep on winning. As always, now new liquidity is getting injected in the market. You have inflation in the market. If you own assets, if you own stocks, I believe this is the reason you are watching this channel, you are winning because Everybody had a gain in 2025. Most people had a nice performance in 2025. Sorry. Congratulations to you. If you are not owning anything, no gold, no silver, no real estate, no stocks, you are losing. This is a K-shaped economy after all, but as always, winners keep on winning. Asset owners keep on winning, and I believe this trend will accelerate because it seems like the US administration wants to have a hot economy to increase the GDP growth. Even with more debt, it's okay, but to increase the GDP growth, to grow again massively, to win the AI race. So they will help businesses reduce taxes to grow again, which means asset owners will keep on winning. This is my take. Maybe I am wrong, but this is my take. In the next few years, at least as long as Trump is the president, asset owners will keep on winning. Wall Street is here in full force, and they have a lot of power. Next point, all companies will integrate AI, but the sentiment varies from companies to companies. Wonderful, right? You have some good companies like Microsoft, like Google, like Meta Platforms that are integrating AI, and we already see the results. And you have other companies like the SaaS companies, software as a service companies, like Salesforce or Intuit or Adobe, that are down, hated. The valuation is getting cheap because people don't really know how they will implement AI inside their ecosystem. So this is the same wave of information. The companies are all great, but for some companies, it's very clear how they will implement AI and it is working fast. And for some companies, it takes some time. Will they be disrupted? Will it work out okay? Will they overinvest? Invest too much? What about the cost? What about the margins? So many questions. So some stocks are going up a lot. Some stocks are getting hated. You look at Salesforce right now, hated. So the sentiment varies widely depending on the companies. And maybe you own these businesses in your portfolio. Maybe you have this in your portfolio. SaaS companies or any other company that is getting disrupted by AI. I would say stay inside your circle of competence. For this situation, you really have to know whether AI will help you or will destroy you. And if you don't know, don't invest in the stock. It's that simple actually. But I know for me, all the stocks I have in my portfolio, I know whether AI will help them or not. If I have a doubt, I don't invest. It's that simple. So I highly suggest you ask this question for your portfolio. If you have a doubt with AI, will AI disrupt my business or improve my business? How fast am I seeing the results? What did the management say about AI? I can have an example with MSCI. MSCI is a company I own, and the CEO is extremely bullish when it comes to AI. MSCI is my fourth largest position. It's 11% of my portfolio. And the CEO literally said, AI is a godsend to us. Let me repeat, AI is a godsend to us. I've never seen such a bullish sentence from MSCI. I can show you the proof of what I say so you don't have to do the work. Enjoy the show, guys. Q3 2024. Let me just put Control F, godsend. Oh, godsend. Look at this. The punchline is AI is a godsend to us. Let me repeat that. AI is a godsend to us because of that. I will not tell you everything in this video. You have to do some work. But yeah, for some companies, the management is extremely bullish, but the stock is hated. The stock is going down for some reason. People don't believe in the management team. Well, we will see. We will see if they are right. We will see if they are wrong. Okay? And another point about valuation. Valuations matter and the market is expensive. Right now, the market is high. Let's not kid ourselves. If you look at the S&P 500 PE ratio, the stock is. You don't need to be a genius to know that the market is high. We have a PE ratio of 31. The last time we had this kind of valuation was in 2021, we know what happened after this. So the market is not cheap. The market is not fairly valued. The market is either a little bit expensive or expensive. How do you invest in this environment? Well, you can invest in companies that are getting hated, for example. I have given you some examples in this video. You can invest in companies that have a PE ratio or forward PE ratio lower than this. You can have some opportunities like this. You can invest in value plays if you want, dividend plays if you want. I would not recommend dividend plays. I don't like dividends. But yeah, at the end of the day, valuations will matter. And if you have a crash in the market, the companies that will be hit the most are companies that are expensive. So maybe you want to move away from companies that are extremely expensive. When I say extremely expensive, I'm not saying PE ratio of 30 or 40. No, I'm talking about companies that have a PE ratio over 50, 60, 70. You need a small shock in the company and the stock can get cut in half actually. You can lose 50% of your value in a few months just because the valuation was too high. So these were all the highlights of 2025 and the lessons you can learn. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.